Thank you very much, Ted. I am truly excited to have these two distinguished gentlemen here for our discussion about NOCLAR, the standard non-compliance with laws and regulations. And what we'd like to do in the time that we have is to tee up the subject, give you a very brief review of the highlights of the standard, and just talk about how did it come about in the international arena. And I don't know that we'll have time for questions, but we will certainly take some if we do have the time for that. All right, confidentiality, and we're here to talk about the price of confidentiality and learn something from the experience of the NASBA, International Ethics Standards Board for Accountants. So we know that this is a fundamental principle that goes without say, and that it's key to having open and candid discussions with our clients and our employers. Now, prior to the development and issuance of a new international standard for NOCLAR, an accountant would be precluded, unless there were a law or regulation mandating it, from disclosing such noncompliance, even where there was public harm. The NASBA standard, what it does in effect, is expand the role and responsibility of accountants. And so, to get us started talking on the subject, I'll pose the question to Richard as to why NASBA adopted and initiated this very important project to look into the NOCLAR issue.
Thank you, Kathy, and good morning, everyone. The origin of this standard was growing public concern about following a number of major failures around the world, which called into question whether or not the public had confidence that accountants disclosed matters that they became aware of in the course of their work. And I say accountants because it's accountants across the whole spectrum. It's not just auditors. And the concern was that the absolute obligation of confidentiality was operating to the detriment of the public interest. Now, I just want to say right up front that there was never an expectation that accountants would be expected to act as civil policemen. That was no part of the objectives of this standard, of this initiative. But there was a recognition that the existing code and the obligation, the fundamental principle of confidentiality, on the face of it, would preclude an accountant from disclosing material matters to a proper authority if it was going to, in any event, irrespective of whether it would be adverse to the public interest. And there was a need, therefore, as public expectations were changing, to look again at the merits of the principle of absolute confidentiality. And I think there's one fundamental point I'd like to make right up front, and that is that this standard is not actually fundamentally about disclosure. It's fundamentally about good corporate governance, because the whole thrust of the standard is to require accountants to disclose matters that are of concern to the company's management, those charged with governance, so that they can investigate it, they can consider what is the proper course of action, and they can deal with it properly. And if they do that, the disclosure issue and duty of confidentiality never comes into issue. It's only if companies do not respond properly to those issues that we end up with the confidentiality issue coming into play. Kathy.
I'm glad you made that point. That obviously is very crucial to understanding how this standard is supposed to work. So let's just take a moment and go through some of the fundamentals. We won't spend a lot of time on this, but for those of you who maybe have not had time to look into the NASBA standard, or maybe hadn't been aware that the AICPA had a similar standard proposed that we'll talk about in a moment, we'll start off with the fundamentals, just a few minutes, on what is NOCLAR, what does it require, things of that nature. So Richard, would you mind?
Well, we start with what are the laws and regulations that it's focused on. It obviously focuses on those laws and regulations that relate to financial statements and the business of the company. but it also catches major breaches of law that an accountant becomes aware of, and over which, in respect of which, he's expected to have knowledge of the laws and regulations. The accountant is not expected to be have an encyclopedic knowledge of all the laws and regulations and the ramifications of them.
Right. So does that mean that if I'm a tax specialist and I happen to be on a tax engagement and I would not necessarily be expected to understand the securities laws or recognize a breach of those securities laws if I was solely devoted to tax and that was the nature of my engagement?
I think that depending on your career and experience, that would be a reasonable conclusion.
So moving along, again, we're still along in these fundamentals. I think this is implied, but maybe we just make it said straight out that this standard applies across the board to all accountants, whether they're in public practice or in industry or in business.
Absolutely.
And can you speak a moment about when the accountant is actually required to do something, when the standard kicks in?
Yes, I mean, when the accountant first becomes aware of breaches of laws or regulation, or even suspected breaches, the first step is to consider the extent to which he's satisfied or she's satisfied that that breach may have occurred or be about to occur. Secondly, he needs to look, and this is really important, to see whether there's an existing obligation to report that breach to some authority, because in some areas, in some countries, that is a requirement, a legal requirement that overrides the standard that NASBA published. And having done that, the next step, and this is absolutely fundamental to our thinking, the next step is to report the information that the accountant has to the appropriate level of management within the company, and if it's a senior member of management, to those charged with governance, the board, so that they can look at it and form their own judgment as to whether there has been a breach and how they should respond to that breach and how the lessons to be learned from it. And they should assess, amongst other things, the implications of that breach to the public at large. Now, having done that, the accountant should evaluate, consider the way the management of the company has responded, and having done that, consider whether or not that response is appropriate in all the circumstances. And it's only after all that has happened and the company, the management, has decided not to do anything or to take some lip service response to the issue, that the question arises as to whether or not you take the matter to an outside party or resign or whatever option you choose to go down. And that test is dependent on how you feel, the accountant feels, the public interest will be affected. And the public interest takes account of the range of stakeholders and the impact on those stakeholders and the extent to which that impact is effectively irreversible to those concerned and of a scale that warrants, in the public interest, the protection of the public.
Thank you. I think that level sets, I think, for the purposes of the rest of the discussion, at least, the who, what, when, where, and how. Thank you very much, Richard, for that. So I'll just speak briefly now about where we are in the U.S. in terms of the NOCLAR standard. And it's not noted on the slide, but you should know that AICPA and many other accountancy bodies throughout the world are members of the International Federation of Accountants, or IFAC, and NASBA is the ethics standard setting arm of that body. And so as a member, the AICPA has an obligation, like all the other members, to set their professional standards, including ethic, so that they are at a level or as strict as the IASBA standard. So in March, the AICPA did release a proposal that was very similar, but also very different from the standard that Richard just described. And in their opinion, it was appropriate for the U.S. environment. It departed in two ways. One was the confidentiality issue in terms of maybe the time is right, and NASBA was one of the commenters on this, that maybe the time is right to open up this discussion of confidentiality and when it should be allowed to be overridden, which is really the gist of the NASBA standard if you take it to the lengths that Richard described. The other one had to do with AICPA also proposed very similar requirements for non-auditors, very similar to auditors. And the comments that came back were that expansion may not be appropriate. They tended to like what NASBA did a little better, and because of the more limited role of non-auditors in public practice. So let me turn now to Mike so he doesn't feel totally left out of the conversation here, and ask Mike to tell us his view on how big a change adoption of an NASBA NOCLAR standard would be in the United States.
It's a great question. The basic points of the NOCLAR standard will be completely familiar to those who have in mind what we call Section 10A. Remember 10, no parentheses, capital A. That was introduced into the United States as an amendment to the Securities Exchange Act of 1934, overriding the veto of President Clinton, if that really takes you back. And the basic points of 10A, now the law in the United States, will sound very familiar when we compare them to the basic points of NOCLAR. What are the basic points of 10A? Well, if an auditor, we're talking about auditors, sees an illegal act, the auditor wants to see to it that the audit committee is appropriately informed, the auditor wants to consider the impact on the financial statements, the auditor wants to evaluate whether the audit committee is taking timely and appropriate remedial actions. There's the element of corporate governance that Richard talked about. And if the auditor concludes that the audit committee is not taking timely and appropriate remedial actions, the auditor does what? Reports outside the company to the SEC. And there's an exception to confidentiality right there. And to Richard's point about corporate governance, I've had any number of discussions with audit committees when I've been representing the auditor along the lines of, look, I know, audit committee, you may not want to do this, but understand that if you don't, we're going to the SEC, and we'll be doing that within 24 hours. And you'd be surprised how that can channel the thinking into better corporate governance. Now, by and large, even in the United States environment, it has worked. It's been a challenge. We haven't figured it out completely, even though it's 20 years later now, but it has largely worked. And we have seen audit committee investigations, and we have seen public press releases reporting problems. We have seen public restatements of financial statements. And one way or another with 10A, financial statements have been corrected, the public has been informed, and life goes on. But, and you knew I was going to get to a but, NOCLAR puts in place a big change. An important aspect of that change is confidentiality, and I'll get to that in a moment. But to understand the confidentiality aspect of it, we need to understand an even bigger change that is put in place by the NOCLAR standard. And that bigger change is that NOCLAR disconnects the profession's responsibility from the fairness of the presentation in the financial statements. Let me explain that. Under the NOCLAR standard, the expectation of the profession's responsibility will extend beyond the financial statements to the deterrence of non-financial harm to the public. For example, environmental protection. For example, public health and safety. Let me make the point in a slightly different way. The profession's responsibility doesn't end with seeing to it that the financial statements are fairly presented. For the U.S. environment, it is hard to overstate the significance of this change for the accounting profession. Now, I want to be very careful here. I am not offering a view that this is good or bad. And in fact, I think a fair argument can be made that the objective is laudable and honorable and noble. I am offering a view that we are putting in place an extraordinary and new expectation. And in the United States environment, we better be prepared to fulfill it. How would this responsibility be fulfilled? Now we get to confidentiality. Absent a confidentiality constraint, the overwhelming incentive on the part of a well-intentioned accountant would be to report any violation that might pose a risk to the public. Why is that? Because big disasters don't start out that way. They start as small problems. Madoff started as a small problem. Enron started as a small problem. And the fundamental problem is that in the United States environment, and you are all going to understand this point, the fundamental problem is that in the United States environment, the profession's fulfillment of the NOCLAR responsibility will be judged mainly in hindsight. Think about how this will work in the U.S. environment. There will be a disaster, an oil spill, a cybersecurity breach, imprudent issuance of credit default swaps. And then my friends on the plaintiff's side of the litigation will look hard at whether the accountants earlier encountered some related violation that can then be traced to the big problem. And keep in mind, they're doing that with hindsight. And today's companies in the U.S. are so regulated, sure as shooting, they're going to find something somewhere.
Now, Mike, can I interject for just a moment? You mentioned that one of your concerns, I think, if I understood you correctly, was that there might be an over-disclosure by accountants because of a concern of protecting themselves from later judgments made against what they did at a particular time, the build-up scenario that you just described. You know, when I think about that, though, I don't know that it necessarily would be a negative to have a matter addressed while it is still a small issue before it does blow up into something that is quite the disaster. I guess that's where I'm getting a little bit of a disconnect in terms of the concern that it would be, and I know you said you didn't think it was a good or a bad thing, but I don't know that in my mind it's necessarily a bad thing to report things before they become disastrous.
Kathy, I'm with you. And I hear you. And look, to your point, if we can nip problems in the bud, if we can cut off Enron before it becomes Enron, if we can cut off Madoff before it becomes a $60 billion loss of investor funds, you know, isn't that a good thing?
Right.
Here's the rub. Okay, I was working with a company, or more accurately, with the auditor of the financial statements of a company, and we were working through just 10A, trying to operationalize 10A and make it better. And what I was told was, and this is a multinational company, operations everywhere, a big company, they had some violation of some rule and regulation somewhere, on average, once every 90 seconds. Now, 99.99% of those are going to turn out to be nothing. How are you going to find the fraction of 1% that blows up into a disaster. And that's the challenge. I don't refute for an instant the objective and the nobility of the objective. The question that I ask is, how are you going to operationalize it?
I think, Richard, it's probably a good person to address your question or to address some of the concerns you raised because he's got the battle scars from the NASBA standard setting.
Go to it.
Mike, you've raised 3 things, 3 points, of which I'd like to come back on. The first is in relation to the significance of environmental and public health and safety issues in relation to the financial statements. You make the point that this standard potentially disconnects accountants' responsibility for financial statements. I have to say, in the world which I live in and the countries that I come from, if you've got an environmental breach of the environmental laws, you as sure as anything have a potential exposure as a company. And that's a liability which is recognized under accounting and auditing standards the world over. So with respect, I don't accept that there's a disconnect in the way you suggest. The second point you raise is what I think you call a fire hose approach to disclosure, based fundamentally on the belief that the company won't be responding, I assume, to the disclosure or the identification of the risk by the auditor and the discussion of that with the company. But that, I suspect, was an argument that was run back when 10A first appeared. I suspect that it's always been an argument against this type of behavior, and the reality is that companies learn how to respond to it. They have appropriate procedures for assessing the risks that you identify, and they then behave, we've discovered, in an increasingly responsible corporate governance manner. I should explain that in the UK, this has been the norm from way back in the 90s. There has not been a plethora of disclosures. I accept that there is a difference in the litigation environment, but nevertheless, there should be no difference in the corporate governance environment from one side of the Atlantic to the other. And I hope very much you're not going to tell me that it's lower in the US than it is in the UK, because I'm not sure that that would be a view that I understand or accept. And so I absolutely contend that this can and should operate properly in the US. I also, you make your point about the 99.9% not being a problem and worrying about the 0.1% or 0.101% that might be a problem. But you know, at the end of the day, companies have to assess risk all through the year. Their job is evaluating the businesses they undertake. Their job is to understand the risks they undertake and to manage those risks. And the real question is whether or not their operations are effective at that, and the accountants in this context under NOCLAR are helping them by making sure they know what the issues are and encouraging them, stimulating them to take a proper approach to those risks when they identify them.
Well, I guess my first reaction is, can I hire you as an expert?
If you pay the proper amount.
Let me try to place it into a nugget. And this is this concept of disconnect from the financial statements. Right now, in financial reporting litigation, and forgive me if this comes across as a bit self-interested on the part of the profession, but that's the role that I am consigned for this discussion. The basic defense, and certainly the defense under 10A, is when all is said and done, the financial statements fairly present the financial position of the company. If there's been a restatement, a press release, or whatever, the financial statements are fairly presented, and therefore we did our job. We're done. The problem is that with the NOCLAR standard, that defense is not going to be a surefire defense. Why? Because the financial statements can be fairly presented. We can have fulfilled our responsibility with regard to the financial statements and still not have fulfilled our perceived responsibility under the NOCLAR standard. That's the problem. That is the nut of the problem, and I know these plaintiffs' lawyers. They are going to look at an oil spill, and they're going to look back to what the accountant knew what the accountant encountered, what the accountant was aware of, and find something. And it may not be legitimate, Richard, but they will find something. And what's the liability? $1 billion? $5 billion? $25 billion? Are we really going to be willing to take that case to trial? And that's the irony. We can be correct. We can conform to the standard and still end up paying very big settlements.
Well,
So there.
Kathy, okay, one last comment, if I may, from me. That is a perfectly legitimate concern for someone representing the profession to express at any time. And that is entirely, I accept that absolutely. I may not agree with it, but it's a legitimate view to express. We're not there trying to produce standards that protect the profession. We're there trying to produce standards that look after the public interest and ensure that the profession's standing in the public eye is as high as it can be. And you heard Kimberly talk about the importance of the public interest to the profession. Recently, I was at a dinner which PwC held, which is called Building Public Trust. It's one of the highest profile accounting events of the year. The accountancy profession can't have it both ways. You either build public trust and work with the regulators in the public interest, or you become much more narrowly focused. And I personally exhort the profession to achieve and stand for those ethical standards that it has promoted and been proud of for centuries.
absolutely. Well said, Richard. Yeah, I would just add, in terms of the United States looking at NOCLAR, you should also be aware that the Public Company Accounting Oversight also has had this subject on its radar screen. In fact, part of the discussion of their investor advisory group was this panel discussion. And they are actively looking at updating their auditing standard for reporting illegal acts. And I think, going back to Mike's comments about that it's not enough to just satisfy 10A, under this introduction of a NOCLAR standard, you do have an additional ethical standard that does go beyond what is in your auditing duties. And I think, you know, we as regulators in this room for the state accountancy boards, for all of us, it's a critical subject for us to finally maybe lay to rest, hopefully, in that again, going back to the relevance, if we do not, if we have to keep hearing this comment about where we're the auditors, and we have to see again and again situations that call into question our relevance, then I don't think we are serving the public interest or ourselves. I believe we may have a hard stop at noon, but if somebody tells me we do not and can take some questions, I would really like to do that. Ted's coming, so I think we might be
Looks
exiting.
like a hard stop to me.
But thank you, Richard, and thank you, Mike, very much. This was excellent.